Welcome to Spiedel's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're covering the recent cost of living adjustment for Social Security benefits, how this may affect the taxability of these benefits, and some tax planning strategies. You can stay up to date on federal tax news with a subscription to Spiedel's Federal Tax Letter. For information on this monthly newsletter and to download a sample copy, go to spiedel.com and click Publications. Social Security beneficiaries will receive an 8.7% cost of living adjustment for 2023, which is the largest adjustment since 1981. The higher cost of living adjustment is good news for seniors who rely on Social Security benefits because it will put more money in their pocket as high inflation continues. But the modified adjusted gross income thresholds at which Social Security benefits become taxable are not adjusted for inflation and have remained unchanged since 1984. This means that even though taxpayers will be getting more Social Security benefits, more of these benefits may be subject to tax. Up to 50% of a taxpayer's Social Security benefits are taxable if their modified adjusted gross income is between $25,000 and $34,000 for a single filer, and between $32,000 and $44,000 for joint filers. If a taxpayer's income is over the top of the income range, then 85% of their Social Security benefits are subject to income tax. If a taxpayer's income is below the range, none of the benefits are taxable. A taxpayer's modified adjusted gross income and taxable Social Security benefits are calculated using IRS Publication 915, Worksheet 1. For most taxpayers, their modified adjusted gross income is calculated as adjusted gross income plus non-taxable interest plus half of net Social Security benefits. The full calculation accounts for modifications to adjusted gross income that won't apply to most taxpayers, like income exclusions for adoption benefits and the foreign earned income exclusion, among other things. Because the income threshold at which 85% of a taxpayer's Social Security benefits are subject to tax is only $34,000 for single filers and $44,000 for joint filers, tax planning in this area is usually geared toward lower income clients. There are some strategies to consider if you're trying to keep income below the Social Security thresholds, and some of these are most effective if they're employed years in advance. For example, for taxpayers who use the standard deduction and have IRA RMDs, consider using qualified charitable distributions to reduce the taxable portion of RMDs. You can use qualified longevity annuity contracts, or QLACs, to shift the lesser of 25% of a taxpayer's IRA, or $145,000, out of an IRA and into the annuity. The funds moved into the QLAC are not subject to RMDs and will begin paying out by age 85. Or consider using Roth IRAs for new investments or Roth conversions to convert traditional IRA funds into a Roth IRA. Roth IRAs are not subject to RMD rules and distributions are not taxable as long as the taxpayer opened their first Roth IRA at least 5 years prior to taking distributions. Roth IRA distributions are not included in the Social Security modified adjusted gross income calculation. To avoid large increases in income, harvest capital gains annually up to the point where the taxpayer's income reaches the Social Security modified adjusted gross income thresholds. Another strategy is to spread income from inherited IRAs over as many years as possible to keep annual taxable distributions as low as possible. Or if the taxpayer has to sell property that will generate large capital gains, consider spreading the gain over 2 or more years if possible, using an installment sale to keep the taxable gains low. You can review other year-end planning moves to discuss with your clients at Spiedel's quarterly federal tax update webinar on October 26th. Go to spiedel.com and click webinars to sign up for a single session or all 4 at a discounted rate. That's all for this week. Join us next time for another episode of Spiedel's Federal Tax Minute.